My name's Simon Pedley. I'm a partner in the disputes team at Mills and Reeve, but I am merely chairing this seminar. The main event is my colleagues Jayne Hussey and Tom Filby, who are partners in our commercial and insurance disputes group, respectively, and they're going to be talking to you today about liability clauses and insurance policies. I will let them explain what that's all about. As you can see from the current slide, this is being recorded and the presentation will be available afterwards. If you have questions as we go through, please put it in the Q&A box rather than the chat box, and we'll deal with questions at the end if we may. In that regard, if there's a particular slide you're referring to, if you can just mention in your question which slide or which point, because that helps us track it down after the event. And also, you're perfectly free to attend and put in questions anonymously. The only downside of doing so means if we don't get round to answering your question at the end of the talk, we can't then follow up with you afterwards, which we would like to do. But so if you ask a question non-anonymously, I won't share your question, your name with the group. I'll just share the question. So feel free to do that. And at the end, once the webinar ends, a survey will come up for feedback. We'd be very grateful to get your feedback on how things have gone today and future talks and stuff like that. So please do wait until that. The next talk in this series, I think, is going to be on the 20th of November. We've got an ESG Insights talk reviewing 2024 and looking ahead to 2025. And that's certainly a hot topic for a lot of us, I know. Any fire alarms, that's your own business, nothing to do with us. I hope you don't. There we are. I think that's all I have to say as an introduction. So over to Jayne and Tom. Thank you.
Okay, Tom, I'll let you kick off.
Excellent. Thank you very much, Jayne. As Simon said, Jayne is in the commercial team at Mills and Reeve, and I am an insurance partner. And I'm responsible for dealing with insurance-related disputes. That includes dealing with policy coverage matters, as well as some claims defence work, and also undertaking policy reviews on behalf of both policyholders and insurers. Some of you may have joined previous sessions a couple of years ago when we looked at liability clauses and insurance, and those were really well received. And Jayne and I thought that given the time that has passed, we would run these sessions again, but in doing so, amalgamate the review of the supply of goods and the supply of services into one easily digestible package. And given the number of acceptances and how many of you have made it onto the call today, there's clearly an appetite amongst the in-house community for that discussion on the interplay between insurance policies that businesses may have in place and the contractual liability that they may agree in the course of commercial or customer arrangements. So in today's session, we're going to cover insurance, as I said, both in the context of both supply of goods and supply of services. I'm going to kick that off by giving you an overview as to some of the insurance policies out there and some of the key considerations that underlie those. Jayne is then going to look at some of the typical contractual liability provisions, and together we'll discuss whether insurance policies might respond to those liabilities. So next slide, please. There should be a honeycomb of the array of different insurance covers available that you can choose from, of course, with the advice of a reputable broker. Which covers you choose and how you structure them is something that will obviously depend on your particular business and what your clients and or customers might look like. And in the way that insurance looks, it could range from anything from a single SME focused policy that covers all of the main corporate and managerial risks under one umbrella, under one policy, or it could be a collection of individual standalone policies. So putting together a number of those that you see on the slide. Next slide, please, Kate. Here is a very short description of some of these policies that you've just seen on the previous slide, and I'll let you look at that at your leisure. But I thought I would pick out a couple of them, first in relation to goods and then services. So if you're a supplier of goods, one of the key policies is likely to be product liability. And this would cover your liability in respect of injury caused to third parties or damage to their property that arises from products you've supplied. Now, it's important to note that this type of insurance does not cover any loss arising from damage to the product itself or its failure to perform its intended function. That sort of cover typically requires what might be called a product guarantee insurance, which unfortunately can be very expensive and carry a high excess before you can get the benefit of insurers' money. Another key policy is likely to be product recall, and we'll come back to some of this in the discussion with Jayne. But again, that has its limitations. In particular, it requires that the defective product poses a real danger to health or to other property, and it's not sufficient that the product is simply defective, whatever the terms of your supply contract might say around this. It's also worth mentioning that there are some more peripheral but no less important covers, such as directors and officers liability insurance. It may not seem that obvious how it applies to the supply of goods, but it's worth briefly mentioning, sort of recounting a matter that I was involved in previously, where there were allegations that the policyholder manufacturer, the cleaning products that they supplied, posed a risk to health. That in turn led to a formal investigation against the company's directors, who, much to their concern, were threatened with extradition to an unfriendly part of Southeast Asia, where there was an official investigation that had been opened into this. Those are matters that were dealt with under the company's D&O, or directors and officers insurance policy, not the product liability one. And so this is a good example why it's crucial that you discuss with your broker and properly understand the range of insurance policies out there and the limitations of each one, so that you can ensure that what you have in place is appropriate for your business and appropriate for the types of engagement that you have with your customers, clients, and other businesses. Turning briefly to services, key policy there, again, depending on the nature of your business, might be public liability if you go in and provide services elsewhere. So similar in some ways to product liability in respect of goods, public liability will cover you in respect of physical injury caused to third parties or damage to their property in the course of carrying out your services. This will generally relate to the physical and, let's say, sort of tangible aspects of the supply, such as the installation of equipment at a customer's premises. But in respect to services, there can also be a more intangible aspect where the service includes an element of advice, consultancy, or design. And whilst we're not going to be sort of case law heavy today, it's worth mentioning the case of Trebor, Bassett, and ADT Fire. Trebor had produced popcorn, which apparently is a very dangerous business to be involved in. They had to engage ADT to design and supply a suppression system that would be discharged in the event of a fire. Now, unfortunately, the system failed and the Trebor factory burnt down to just a few husks and kernels. It was asserted that the matter concerned the supply of goods and matters of fitness for purpose and quality. But the court disagreed and found that ADT's responsibilities and liability flowed from the supply of design and installation services. So even if ADT goods were being supplied, this was within the context of a service. And that distinction can be highly relevant, not just to the nature and extent of the legal liability in question, but also to policy coverage and which type of policy response. And it might well be that damage arising from a misconceived design would instead be viewed as a professional liability matter rather than one of public or product liability. Again, much depends on the terms of the policies and the factual background. And it's also worth briefly noting on this point that the concept of professional liability has evolved over time. Previously, it was the preserve of traditional professions such as lawyers, accountants, but the availability of professional indemnity insurance and the demand for it has shifted into a space that's now occupied by services business that go way beyond what the court and the law might regard as quote, professional. And this ranges from fitness coaches through to security systems suppliers. So professional liability insurance is something that is very well can apply outside of what you would ordinarily regard as the traditional professional. And again, highlights the importance of considering carefully and precisely what services your business is supplying and to understand on what basis you are interacting with your customers and other business partners. Are you, for instance, providing a form of consultancy service, almost inadvertently, perhaps? Next slide, please, Kate. Turning to policy considerations, I wanted to briefly touch upon a couple or sort of three key points or three kind of underlying premises that pervade across liability policies and policy coverage in the supply of both goods and services. Again, much will turn on the specific policy and its wording, but there are a few fundamental principles that I think are important. The first one noted on the slide is the underlying premise of liability policies that require an actual legal liability to exist. Unless the terms of the policy provide otherwise, the mere fact of an allegation being made is generally not sufficient to establish a right to recover under liability policy. Now, often there's a different position for defence costs where mere allegations can suffice, but that's not always the case. In terms of establishing a liability, strictly speaking, we're talking about judgments of a court or other adjudicator. It's important in this regard to note that a settlement with a third party can run the real risk of not satisfying the actual legal liability requirements if it's viewed as a purely commercial settlement and not reflective of actual liability. The leading authority on this is AstraZeneca and XL Insurance, but also more recently, Technip, just this year, Technip and MedGolf. And in that case, Technip settled claims for $33 million. But the court, looking at policy coverage when a dispute arose, because Technip hadn't consulted its insurers around the settlement, the court said, well, Technip could only recover 7 million of that 33 from insurers, as it was only 7 million that was a representative of its actual legal liability. The balance of it seems, have been paid to dispose of a problem on a purely commercial basis. So obviously, one way around this would have been to have engaged insurers at an earlier stage and obtained their consent to the settlement. And whilst insurers may not have gone as far as 33 million, they might well have been persuaded to go some way north of 7 million in order to dispose of tricky litigation. So commercial settlements, commercial imperatives can be very important, but you need to make sure that you are having regard to those with the consent and agreement of insurers. So key point there is take the time to review your policies, understand what triggers the cover, and also keep insurers updated and engaged in all key decisions. And where reasonably avoidable, never settle a claim without insurer's agreement. Sorry, the lights are switching off in the room. Hopefully you can still see me. I'm faded away. The second point to highlight is that the true nature of the claim or loss, and not merely how the claimant has chosen to frame it, is what determines whether there is a legal liability that triggers the policy. So within a supply of goods or services context, the case of Omega Proteins and Aspen Insurance is a good illustration. So there, the policyholder had wrongly classified their meat product as suitable for bone meal, whereas it wasn't fit. It was only fit for disposal. The claim that ensued from damage and injury caused by the product was framed in contract only, and the court judgment that followed reflected that. So on the face of it, the determined liability fell outside the scope of the supplier's product liability cover. And that's very normal. It's very normal in all types of liability policies that there will be an exclusion of any liability arising under a contract unless such liability would have attracted in the absence of contract. Now, the reality in that case, it was determined, was that the contractual liability of the supplier was concurrent with a like-for-like tortious liability that also existed at law and outside of the terms of the contracts with the customers. So when the court, looking at policy coverage, looked at this matter, they held that the product liability policy could still be triggered on this basis. So in other words, it's available to an insurer and the policyholder to look beyond any judicial determination or how a claim is framed and to identify for themselves the true nature of the claim or liability for the purposes of determining policy coverage. And you can see how this principle is particularly important where there are so many liability clauses in commercial contracts that purport to set out the grounds for a contractual liability. On the face of it, all of these liabilities would, in the vast majority of cases, fail to trigger insurance cover. But you're saved by virtue of looking behind the contract at what the liability might be at law. And if there's a concurrent liability at law, such as around a duty of skill and care, then you ought still be able to trigger policy coverage. Third and final aspect to mention is exclusions, and that overlaps largely with what I've already said around contractual exclusions, which will typically be one of the key exclusions under any type of liability policy, any of the type that were shown on the slide before. And so it's important when drafting a contract, agreeing contracts, that you have regard to the interplay between those, what you're signing up to contractually or expecting of your counterparty to sign up to, and to what degree that would be concurrent with a liability that would have the financial safety net of insurance. All of which leads neatly on to Jayne, who will go through some of the typical liability clauses that we come across, and together we'll take a look at how insurance might speak to these.
Thanks, Tom. So I think the first thing, folks, I'll say is this isn't a drafting lesson as such. What Tom and I are going to do is I'm going to talk about some clauses that we typically see in a contract where it's a business-to-business supply and we are advising the supplier and the terms have been sort of given to them by the customer. I will pass a few observations as to commercial points that I'd be talking to with the supplier, but also asking Tom his observations in terms of that interesting interplay between the contractual provision and the and insurance cover, and whether insurance will respond. So firstly, we're looking at goods, and then we'll take a look at a services clause. So Kate, if you could move to the next slide. Here you are. I expect many of you will have seen this type of clause. So a customer is requesting effectively a product warranty. The products that the supplier supplies are going to comply with the spec, conform with regulatory requirements and applicable laws, are of satisfactory quality and fit for purpose, free of defects in design, material and workmanship. From my sort of commercial contracting perspective, there's a number of things I would be asking, such as, well, actually, can you comply with the spec? Is it your spec or is it your customer's spec? So do you actually have sort of intellectual capital in this product, or are you more of a, what we might call a make to print supplier? Because that informs the position we might take on some of these other quality assurances that the customer is seeking. Equally, I would be looking at the definitions of regulatory requirements and applicable laws, because if you're the customer, you're going to draft them incredibly widely to think about every market that this product might go into, or you know, if it's a component part, where the end product is going to end up. And you will try and draft those really widely. And if you're the supplier, you probably don't know whether what you're supplying complies with all applicable laws. So actually, Tom, on this point, my question to you, thinking about this from the insurance perspective, is, are there sort of jurisdictional or territorial limitations to insurance cover? I mean, I'm assuming that this would probably speak to, on the whole, a product guarantee insurance policy if somebody had one. But just your observations on the sort of jurisdictional scope of a policy.
Yeah. So again, it very much depends on the nature of the policy and whether it responds to claims being made against the policyholder, or if it's what we call a first party loss. So it's a loss that's suffered by the policyholder itself. But generally, all policies issued out of the London market will be expressed to be subject to English law and jurisdiction in terms of the interpreting policy response. But in respect of the territorial reach, let's say, of the policy, the vast majority will be worldwide. And for instance, if you have a claim that arises in Timbuktu, then that will be the territory to which the policy responds. The terms of the response will depend on English law interpretation of whether the claim in Timbuktu has all the elements that triggers cover under the policy. It's probably worth noting that if you're a business that does a lot of work or sort of supply of goods or services in North America, because of the litigation culture out there, and quite frankly, the eye-watering costs that us English lawyers only wish we could charge, there tend to be sublimits introduced in policies in respect of claims in North America. So that means that the limit of indemnity available to you in relation to losses and cost cover could be less, or there might be other exclusions. So particularly if you're doing any business in the US, it's important to have regard to that. I would also say that operating in different territories is something that insurance underwriters regard as let's say, sort of a material fact that they want to be aware of when they are assessing the risk prior to policy inception, when deciding whether to issue an offer of insurance at all, and if so, on what terms, whether that be in respect of level of premium or other conditions attaching or territorial restrictions. And so it's really important that when you as a business are completing the proposal form for any type of liability insurance, that you take real care in providing complete and accurate information as to the territories in which you are operating. If you fail to do so, it can have rather disastrous consequences on entitlement to cover should a claim or loss unfortunately arise.
That's an interesting point, actually, Tom. I'm just casting my mind back to a client that we helped, and they had been supplying shelving, let's say, and the shelving was being installed in a warehouse, and it was a pure supply of goods. However, when the shelving had gone in, there were some adjustments that the supply business thought that the customer ought to make, and so they made a recommendation. And anyway, it all went wrong, and it went wrong on the basis of the advice that had been given. And the interesting thing was that the customer, the supplier rather, was giving this advice just to be helpful. They weren't charging for it. It wasn't part of what they had tended to supply. And the issue that arose there was the insurance cover did not extend to that advisory element. So I think that's an interesting commercial piece in the context of sometimes, sadly, controlling the helpfulness perhaps of salespeople and the promises and ad hoc advice that is given in the context of insurance cover. So that's just an observation.
Yeah, no, absolutely. And that goes back to the point I made earlier that professional indemnity insurance, which ought to respond to that sort of situation, is no longer the preserve of the traditional professions. And let's say the court may still have certain views around what a profession means. And I think there are 4 pillars to that definition. I won't go through them now. But insurers take a very different view. And if you're paying premium to get the policy, they're quite happy to issue a professional indemnity policy to a wide range of businesses that may find themselves in a position where they're providing advisory or consultancy services, even when they're not for a fee. And there are cases out there that have established that paying a fee for advice is not a necessary component of the entitlement to then hold a professional or non-professional service provider to account at law, and putting to one side the contractual sort of aspects. So if either you are engaged in providing those sorts of advisory services, or there is a real risk that you may do so inadvertently by seeking to be helpful, then professional indemnity insurance is potentially something to look seriously at.
Yeah, thank you. A couple of other points on this slide. Actually, if I were acting for the supplier, I would be trying to get rid of that third limb, the satisfactory, quality and fit for purpose, or at the very least defining what the purpose is and ensuring that the supply business understood that. And then the fourth limb there, defects in design, material and workmanship. Well, actually the question comes as to, well, whose design is it? And I would also be looking to inject an element of materiality in that into that limb. So Kate, I'm conscious of time. If we could just move to the next slide. Now this slide is really one of those typical remedies. If the customer doesn't like what you've supplied, they can reject them and you have to repair or replace within 5 days or repay them the price in full. Or that third limb is reimburse the customer if they have to source goods from elsewhere. Tom, a very quick question for you here. I mean, from my perspective, one of the things I would want to do is get rid of that language in 1.2, which talks about without limiting any other right or remedy the customer may have, because of course that opens you up to damages claims. But my question for you, Tom, is my assumption around sort of product guarantee insurance is that it probably wouldn't, it's unlikely to respond to that type of contractual remedy in terms of repair or replace, because the deductibles and whatnot would actually preclude it, or it's probably excluded anyway, policy wise. Is that a fair assumption?
Yeah, I mean, there's a range of policies. I mean, it might be that there are product guarantee policies that do provide a degree of cover where there is damage to the good itself as opposed to other property or other persons. And product guarantee can provide cover for what we might call pure economic loss in that respect. So again, something which is other than damage to other property or people. But as you say, the cost of that is, my understanding, but consult your broker, can be prohibitive, and the policy deductibles or excess that apply are very high. So you would need to assess whether that type of cover really is important for you. I mean, you do get obviously the sort of product recall policies as well, which can apply in that situation and can provide cover in respect of the good itself, but those in turn are limited to situations where the recall is as a result of some kind of risk of death or injury or property damage.
Tom, you're reading my mind, because my next clause is around recall. Yeah. No, you're reading my mind. So, Kate, if you move on to the next slide. So again, this is a pro-customer product recall clause. And the notable thing about this is in 2.1, where the recall is purely down to the decision of the customer, and it's if the customer considers the goods are defective. Now, and again, Tom, do correct me because you're the expert, not me, but the fact a customer considers a product defective does not necessarily mean the supplier's product recall insurance is going to respond to that, because it is generally a health damage to property scenario. Is that right?
Yeah, but precisely. So product recall is rather limited. So it would only respond to, again, as I just mentioned a moment ago, it's, as you said, risk of death, injury, property damage. Anything beyond that would not, I mean, subject to the breadth of cover being provided under product recall, would not be covered under the typical policy. And you mentioned clause 2.1, and I think it would need more consideration, but one thing that jumps out as me is the reference to non-compliance with applicable laws, that being a trigger. And that feels to me really quite broad. What applicable laws are we talking about, particularly if we're looking at other jurisdictions where there could be some kind of strict liability or prompt for a product recall situation, but isn't one that is recognised in the same way in the UK, and which might not be reflected under the terms of your English law policy. So again, that's about understanding. So I mean that phrase potentially is objectionable in terms of its breadth and it being vague. But alternatively, it's about knowing your marketplace and in what situations that recall can happen. But certainly a customer demanding a recall, they may well have a right under the contract. But if that goes above and beyond the recall triggers that exist at law, then that's likely to be viewed as a contractual only liability, and in turn will trigger the contractual liability exclusion in the policy that the product recall and pretty much all liability policies will contain.
Okay, thank you. Next slide, Kate. I mean, this is really a mechanism that we will typically see that a customer wants a supplier to comply with if the customer decides there should be a product recall. That there are actually some practicalities here in terms of the ability of a supply business to respond in the way that the customer wants. So, for example, within 4 hours, and telling the customer the location of all the recalled goods, that actually might be quite difficult in the context of the fact that a lot of businesses operate on centralized warehousing, for example. And then next slide, Kate. please. And then, of course, this is what I would call the all singing, all dancing indemnity for the benefit of the customer. If there is a recall, from a commercial perspective, I'd be trying to get rid of the indemnity completely and having a cap on liability. If I couldn't get rid of the indemnity, I'd be looking to curtail it significantly and again limit the liability. But again, Tom, from almost a yes no answer, the fact that somebody has agreed to a contractual indemnity does not mean that the recall insurance is going to respond and fulfill that indemnity cover.
No, and that's it. So you have to contain me to a yes or no answer, as I tend to go on a bit sometimes. You're quite right in doing so. No, it's absolutely right. I mean, if it's a contractual only liability, then starting point is regard it as almost certainly excluded. Yeah.
And then we were going to take a 2-minute look at a services clause. So just roll on to the next slide, Kate. This is another one of those very wide quality insurances that a customer is looking for from a supplier. You as an audience are a sophisticated audience, so you will have no doubt the same observations as I have. But for example, in B, the incorporation of the supplier's tender response, we would be looking to remove that. And as for the deliverables being fit for purpose, actually query what is the purpose of the deliverables. I'd be trying to get rid of C and D because I consider those to be very subjective standards in terms of best practice, best quality, and so on. And then just rolling on, because what I would like to do, roll on again, Kate, because I'd like to just talk to you, Tom, very quickly about the liability provisions in this services contract. You can see that there are a number of heads of loss where there's unlimited liability. And one that I want to pick out and ask you about, Tom, was TUPE. So this services contract contemplates that there is a TUPE transfer on entry and exit. And I think this comes down to sort of the issue of employment liability. So for example, if you were to inherit or on an exit, there to be a liability relating to an employee accident, a health and safety incident, how would an insurance policy respond to that?
In a TUPE, so I don't profess to be an expert on TUPE, so I'd probably defer in part to our employment team and others. But my sort of general understanding is that if there's a TUPE transfer of let's say an employee that suffered some kind of accident at work, and that happens before they've made a claim or before it's resolved, the position is that I believe it's the new employer that then assumes the liability for the accident. And the position has developed such, and it will be in terms of the reflecting the policy, I suspect that the new employer also has the benefits of the old employer's insurance.
Right.
So in principle, all good. The one thing that strikes me, and I'm not aware that this has been made clear sort of through the courts, sort of through law, is, I mean, who for instance takes on the burden of the excess that might be applicable under the policy? Is it the old employer, the new one? That might well be something that's within the terms up for negotiation within the contracts as part of the TUPE arrangements. But there are a few things to look out for there. So if you are a new employer, then you probably should be doing some due diligence around what insurance benefits you're inheriting in respect of any I suppose sort of TUPE related risks out there, and just check, for instance, that the level of cover and everything is good, and indeed what the excess might be, and who's bearing that.
Yeah, I mean, the death, personal injury by negligence, Tom, I'm assuming that might be a public liability, for example, depending on.
Yeah, so public or employers liability would be the policies that respond to that.
And what about fraud? What would respond to that?
Yeah, I mean, whole range of policies. So it really depends on how the fraud has been carried out, by whom. I mean, is it a fraud where so I mean, for instance, if you've got a business, if a director has been duped by a fraudster into transferring funds to a fraudster, whether it be the business's own funds or clients' funds, then we could be talking about a number of policies that may respond to that situation, all depending on the claim. If it's a claim that the director did something wrong in the discharge of their managerial responsibilities, then you could be talking about D&O insurance. It could be professional indemnity insurance if it relates to a client's funds whom you're advising. You've got commercial crime policies out there, fidelity policies that relate to employee fraud, so it's an employee that's siphoned funds off, and cyber as well. Again, very much depends on the nature of the fraud and who's carried it out.
Brilliant, thank you. And last slide from me is, you'll be pleased to know that there is supposedly a cap on the supplier's liability in this contract, and my observations from a commercial contracting perspective on this clause that you can see 2.2 would be that actually these aren't really caps at all, because they are per event caps. So I'd be looking for ideally total aggregate caps or annual caps. I would also point out that actually what we would want to do with this clause is it not just be limiting liability in contract, but also in tort for misrepresentation and so on. And that isn't clear, you will see from the start of 2.2. Last question from me, Tom, is on that Lim B, data protection. Would that type of liability typically be responded to by a cyber policy? Obviously, policy terms accepted and needing to be looked at, but where would a data protection breach tend to sit if people were looking to work out, do we have any cover?
Yeah, well, I'm going to answer two questions because I think actually you raised the point that I'd like to respond to as well. I forgot time. But the data protection, again, it's a bit like fraud. It depends what's happened and who's bringing a claim on what basis. So a cyber policy would be a fairly obvious place that it might be housed. And certainly that's where we see it commonly. But if it's to do with a manager doing the wrong thing, let's say sort of being careless, it might be a D&O policy again. It could be professional negligence if it's argued that there's a duty of care to preserve data, for instance, and a client says they failed to do that. So there could be a range of policies. What I was going to quickly pick up is what you said around the sort of series of events and aggregate sort of limits of liability on under the contract. Insurance policies have limits of indemnity, and there can be a key distinction between those that are, let's say, 1 million on an aggregate basis, which means that there's a maximum of 1 million available during the policy year, irrespective of how many claims, events, or series of events, whatever there are. Alternatively, maybe 1 million on each and every claim basis. So if there are 10 claims or losses, you could potentially get up to 10 million in cover. And so when you're looking at the sort of contractual basis for aggregating liabilities, let's say, it probably makes sense to have regard to how that is aligned with the position under the policy in terms of aggregation as well.
Thank you. Thank you. So I think that brings our little canter through to an end. And I think, Simon, you've been sort of keeping a track of questions and working out if you can group them.
I have, and I don't think we'll have time quite for everyone, but thank you for this. To the people who first asked, will the slides and will the video of the talk be circulated? Yes, that should all happen seamlessly. If it doesn't, message one of us and we'll ensure you get that. To the person who had the very specific question, which you acknowledged might not be for the wider group, about they're sending a worker to work in the States and the insurance requirements by the the state in question and how that interacts with their own insurance and similarity of policies and stuff. I think that's a separate question for follow-up, but thank you for that. So a couple then. One, with two people asked the sort of flip sides of the same thing around the point you made, Tom, about concurrent liability, where the case where even if the claim was brought for breach of contract, if there was a concurrent tortious liability which the policy covered, that would do it. So one question was, is the concurrent liability approach excluded if the contract expressly excludes liability outside the contractual liability provisions? And the flip side question, I think, was, it's often a standard provision in B2B contracts that there is an exclusion of terms implied by common or statutory law and reliance purely on the contracted terms. Presumably, given the fact that the true nature of the claim and loss is what frames liability for insurance purposes, we would want to avoid such exclusions to ensure that we can look to concurrent liability at law in order to trigger insurance cover where the contract doesn't go far enough. So I assume that makes sense to both of you. So between you, what do you think?
Yeah, I was going to say that remarkably insightful questions, and it's something. It's not trying to sort of defer. I'd want to consider that carefully, but potentially you could be looking at the omega proteins type of situation where even if there are constraints around the way in which a claim can be framed, so for instance, limiting any customers or other businesses' claim to one purely in contract and not being able to avail themselves of any other cause of action, that could well govern how a dispute, business-to-business disputes, happens. But the question of whether the insurance policy would respond is potentially entirely separate. And so if you would strip it back and say, well, it's appropriate to effectively ignore what the contract says around disapplying liability of any other kind, if the reality is that the policyholder could have been, but for the contract, sued in respect of a tortious liability, then my instinctive reaction is that the policy ought to respond on the basis that it has a regard to a different, it's separate from the underlying dispute in that sense.
Thank you. That's great. One question from an anonymous attendee, so I'd like to cover this. Would you need product liability insurance for things like marquee hire, or I suppose what insurance would cover that sort of supply?
It depends whether you're the one providing the marquee hire, I suppose, or hiring the marquee and taking something into your possession, let's say. So if you go off and damage the marquee that you've hired in, when you're using it for events potentially within a business context, because you are, so if you're a business that's using a marquee to host an event, you would be looking at whether you would have the benefit of, I wonder if property insurance might respond to that sort of thing, where you come into possession and control of property, even if it's been sourced from someone else and effectively belongs to someone else. That I would have thought would be the type of cover that would apply. If you're in the business of providing the hire of marquees, then again you'd be looking at you'd be looking at public liability, product liability, on the basis not of damage to the marquee itself, but if the marquee were to fall over and injure people, or property of belonging to the people that are hiring it, so third-party property.
Thank you. And I think just because of time, there's a few specific questions which we can follow up on, and we will do so. One more from an anonymous attendee, and this is a point I was thinking about. What is the insurance industry's approach to uncapped indemnities in goods and services contract? What extent if you have this the sort of clause that Jayne wants to negotiate out, to what extent are you covered? And do the insurers, I suppose, just is my question, just rely on their limits of liability in the insurance contract, or do they ever actually get involved in the substantive contract themselves?
I mean, you pretty much answered your own question there, Simon. It's insurers. So what insurers want to know, and frequently the proposal form, depending on the type of insurance, will ask questions around what was your biggest transaction, for instance, or what is your biggest contract value, and that will have a material bearing on the terms that insurers issue. And provided that you provide an accurate picture to insurers, that ought not to matter. What the insurer will then do is obviously say, well, this is your limit of liability under the policy, whether it be on an aggregate basis or any claim basis. And effectively, that's what then governs the relationship. If you go off and agree an unlimited liability with your customer, another business, it's that's irrelevant. If you agree to be liable for something that could expose you to a 10 million loss, but you've only got 1 million level of insurance cover, well, bad luck. Insurance will be, well, yeah, we're still sticking to 1 million. We're not going to extend to 10 million. What you said in promising the contract is your business, and there's no expectation on the part of insurers that you would have liability caps in place contractually anyway. Again, it's not relevant to them. What's relevant is I mean, you could say in the proposal form, we have capped our liability in every single contract we enter into at 500,000. And on that information, then insurers might consider that material, and that will influence how they provide terms. That's the only situation where I can see it being relevant.
Fantastic. Brilliant. Great. Feedback, we're going to finish in a moment. The survey will come round, and as I say, the slides and the recording of the talk will come round. And for those who said it was helpful and they've enjoyed it so far, thank you very much. And please say so in the survey. As I mentioned at the outset, for those who had joined by that stage, this is going to be our next In-House in Focus seminar on the 20th of November, and I hope as many of you as possible can come to that. We will try and follow up with those others who have asked questions otherwise, but other than that, thank you very much for attending. Jayne, Tom, thank you very much. That was very interesting. And to all the attendees, hope we see you soon. Thank you.